Have you ever dreamed of achieving, true financial freedom, where you actually control your money instead of it controlling you?
Yeah, that feeling of being in the driver's seat.
Exactly. Welcome to the Deep Dive. Our mission, really, is to take a whole stack of powerful insights from leading experts and boil them down.
Make it your shortcut to being truly well-informed.
Right. Setting you on a clearer path toward financial success.
And today, we're diving deep into a really interesting one. Nick Maggiulli's book, Just Keep Buying. Proven Ways to Save Money and Build Your Wealth.
Gagley. He's a COO and data scientist over at Ritholtz Wealth Management, right?
Yeah.
And he has that blog of dollars and data.
That's the one. He's got this knack for, cutting through all the usual financial jargon, offers up some surprising facts, really practical advice, and it's all, importantly, grounded in solid data.
Okay, so we've done the homework for you. We've gone through the research, looked at the numbers, and pulled out the most important stuff.
Key takeaways.
Exactly. So before we really get into Maggiulli's world, maybe just take a quick second now.
Good idea.
Like this deep dive, if you're finding it useful already,
Yeah.
maybe share it with someone you know who could use these insights.
Definitely.
And of course, make sure you subscribe to the deep dive so you don't miss out on future episodes. We want to help you gain that knowledge, quickly and thoroughly.
Okay, let's jump in. Maggiulli's core philosophy. It sounds almost, too simple at first.
Right.
His main idea, the title of the book actually, is basically it's not about when to buy or how much to buy or even what to buy.
It's keep buying.
Just keep buying. That's the core of it. Counterintuitive, maybe?
It feels, too simple. Especially when, our gut tells us we need to analyze everything, optimize, try to time things perfectly. How does his data really back that up? Because emotionally, that's tough. We often want to do the opposite, right? Hold back when things look scary.
That's exactly his point, though. It's not just about being simple. It's about fighting that human tendency to overthink, to get paralyzed by analysis.
Paralysis by analysis.
Yeah. His data, overwhelmingly really, shows that overanalyzing, it often costs us way more in missed opportunities and just sheer stress than it ever gains. He shows that chasing the perfect strategy is mostly, like he says, an exercise in futility. Markets are often irrational, unpredictable.
So consistency beats perfection.
That's the idea. Consistent action over the long run, that's the most reliable predictor of success, according to his research.
Yeah, fascinating. So if just keep buying is the mantra, where do we start? His book kind of breaks down into two main things, right? Saving and investing.
That's right.
And he kicks off saving with something pretty provocative. He says, saving is for the poor and investing is for the rich.
Whoa. Yeah, that one makes you stop and think, doesn't it?
It does. What's he getting at there? Is he being dismissive?
Not at all. Not dismissive. He's highlighting a really important nuance, like where your focus should be depending on where you are financially.
Okay.
So if you have fewer assets, saving is absolutely critical. It's step one.
Right.
That's how you build your initial capital, get that emergency fund sorted, just create some breathing room.
Building the foundation.
Exactly, building the foundation. If you've only got, say, $1,000, obsessing over investment returns on that small amount, it's not nearly as impactful as figuring out how to save more.
Okay, that makes sense. Saving builds the base. Then, as your wealth grows, you get a decent portfolio going. The focus shifts. Investing becomes the bigger lever for actually compounding that wealth, not just stacking up more cash.
Yeah.
Is that the save-invest continuum he talks about?
Precisely. You nailed it. And that leads right into his point about the power of income.
Yes. Income.
Maggiulli argues that for a lot of people, focusing on increasing income is actually much more powerful than just trying to make extreme spending cuts. Think about the basic formula. Savings, income spending. Right.
Simple enough.
But for lower income households, cutting spending often doesn't leave much room to save anyway. Income might just barely cover the necessities.
You can't cut what isn't there.
Exactly. It's just not practical or sustainable to cut much further.
And this is where that whole you don't need to cut your lattes thing comes in, isn't it?
Yeah.
Because personal finance gurus always tell you to cut the small stuff.
Yeah.
But he's saying for many, the real leverage is on the income side.
That's a big part of his argument. Not that spending doesn't matter, but that income generation can be a bigger needle mover for many.
So what does that mean for how much we should be saving? Is there a magic number?
Well, that's the thing. He stresses there isn't some rigid rule that fits everyone. It's more about adapting to your specific situation.
Flexible.
Yeah, very flexible. He calls it phenotypic plasticity, which is a fancy term from biology, but basically means adapting.
Okay.
He does suggest aiming for maybe 15% of your earnings as a minimum baseline, if possible.
But the main thing is consistency.
Yes, save what you can. Even small amounts done consistently add up significantly over time. It's about building that habit, making it realistic for you.
Okay, let's shift a bit. Maggiulli talks about the ultimate asset, time.
Ah, yes.
So he says time is and always will be your most important asset. Nothing can buy you more time. We hear that a lot, but what's the deeper angle here beyond just, compound interest?
It's huge. Compound growth is definitely part of it, a massive part. But it's also about recognizing that unlike money, you can't earn more time. It's finite.
Right, it just ticks away.
So every day you put off starting, you're not just losing potential returns, you're losing the actual power of time working for you. Time you can never get back.
Irreplaceable.
Totally irreplaceable. That's why even a tiny amount saved consistently starting today can end up being worth way more than bigger amounts started years down the road. It's kind of the bedrock truth for long-term success.
Okay, that naturally leads us to market timing. One of the biggest debates, always. Maggiulli seems pretty firm here. He calls trying to time the market, predict the ups and downs, an exercise in futility. Why so definite? It's so tempting.
It is tempting, but he backs it up with data. The market is often, well, irrational.
Doesn't always make sense.
Right. It can jump on trivial news, ignore huge news, rally on disasters, tank on miracles. Our brains want patterns, but the market often just doesn't play fair with patterns.
Ah, yeah.
His core principle is that most stock markets go up most of the time. So if you're trying to jump in and out,
You miss the good days.
you inevitably miss some of the best days. And those few best days, they have a massive, disproportionate impact on your long-term returns. Missing them really hurts.
Okay, but to be fair, there's some nuance mentioned in the sources, right? Like lump sum investing, buy now, put it all in at once, often beats dollar cost averaging statistically.
Right, that's generally true over long periods.
But some argue for pricing the market. Like maybe waiting if valuations seem crazy high, especially for shorter term goals.
Yeah, that's a valid point for specific situations or maybe more active strategies. If valuations are in the stratosphere, maybe you DCA instead of lump summing, for example.
But Maggiulli's main message stays the same.
His overarching message, especially for typical long-term investors, is definitely just keep buying consistently. Trying to outsmart the market by timing entries and exits, it's a gamble. Rarely pays off over decades.
Consistency over cleverness again.
That's the theme.
Okay, so if we're just keeping buying consistently, what should we be buying? Does he get specific?
He's a big proponent of low-cost index funds.
The standard advice, but for good reason.
Yeah, they give you broad diversification, track the market effectively, and you don't have to get into the weeds of picking individual stocks.
Which can be a roller coaster. He has that story about his friend Darren and GameStop, right?
GME.
Oh yeah, the GME saga. A perfect illustration of how wild and emotionally draining individual stock picking can be. Darren learned that the hard way. But the sources also make it clear there's no one true path to wealth.
Diversify. Exactly. It's about consistently buying a diverse set of income-producing assets. So yeah, stocks via index funds, but also maybe bonds, real estate, even things like royalties or your own business or products. Diversification is key.
And what about the ups and downs, the volatility? Markets go crazy sometimes.
He says don't fear it. He actually calls volatility the price of admission for getting those long-term investment returns.
So the price of admission. I like that.
It reframes it, doesn't it?
Yeah.
He even shares that wild story about Fred Smith, the founder of FedEx.
Oh, the casino story.
Yeah. Risking the company's last $5,000 playing blackjack in Vegas just to make payroll and keep the company alive. Desperate times.
Wow. What's the investing lesson there? Gamble your savings? Probably not.
Haha, no, definitely not advocating gambling. But it's a powerful point that sometimes inaction or being too afraid of risk can actually be the bigger risk.
Playing it too safe.
Right. Smith had to take a calculated risk because the alternative was certain failure. For investors, the point is leaning into the discomfort sometimes.
Like buying when the market is down.
Exactly.
Huh.
Historically, buying during big downturns, like when the market's dropped 30% or more, has actually led to excellent returns down the road, often over 10% annualized.
Takes courage, though.
It takes courage, absolutely.
Mm.
But accepting volatility as just part of the process, not a sign something is wrong, that's essential for long-term gains. It's a feature, not a bug.
Wow. Okay. We've covered some really crucial stuff. Consistent buying, income, time, volatility. Before we get into the psychology side of things, let me just ask you, listening right now, from everything we've talked about so far, what's maybe one insight that really stands out?
Yeah, what resonates?
Or maybe one shift you might think about making in how you approach saving or investing. Pause and think about it.
Yeah, definitely. And building on that, let's talk about behavioral finance, how our own minds play into this and how we can create a more, balanced financial life.
Okay.
Maggiulli introduces something he calls the 2X rule. It's in guilt-free spending.
Ooh, guilt-free spending. Tell me more.
The idea is pretty simple. For every dollar you spend on a splurge, something non-essential you really want, you have to invest an equal amount. So spend $100 on a fancy dinner, invest $100 too.
Ah, that's clever. It's like a built-in governor, almost. Lets you enjoy things, but keeps you honest about your long-term goals.
Exactly. It helps take away that nagging guilt some people feel when they spend money on themselves.
Right.
It aligns your spending with your values, allows for enjoyment, because, like Maggiulli says, your money should be used as a tool to create the life that you want.
I like that. Money is a tool for life, not just a score.
It lets you spend consciously without feeling like you have to be extremely frugal about everything. It recognizes money is for living too, as long as future you is also taken care of.
And that ties into handling lifestyle creep, right? That thing where as you earn more, you just naturally start spending more.
Oh yeah, the silent wealth killer.
He uses the Vanderbilts as an example. Huge fortune,
Yeah.
kind of dwindled away over generations, partly because of unchecked spending.
Yeah, a classic historical example of how even vast wealth isn't immune if spending consistently outpaces growth or income generation after generation. Lifestyle creep is insidious.
So how do we fight it without feeling deprived?
He suggests the 50% spending rule. Pretty straightforward.
Right.
When you get a raise or some other income increase, limit the extra spending to just 50% of that increase.
And the other 50%.
Save it, invest it, use it to accelerate your financial goals.
That seems reasonable. It lets you enjoy some of the fruits of your labor now, but ensures a good chunk goes towards building future wealth.
Exactly. It's about finding that balance, enjoying today while still being responsible for tomorrow. Intentional choices.
This whole philosophy seems to carry over into retirement planning too. He says retirement should be a lifestyle decision, not just a financial one. He mentions the 4% rule, saving 25 times your expected first-year spending in retirement. That's pretty standard advice. How does that fit with his flexible approach?
Well, the 4% rule is a good starting point, a benchmark. But it's interesting, he notes that studies often show retiree spending actually tends to decline over time.
Oh, really? Not stay constant or increase.
Often, yeah. People
Right.
tend to slow down, travel less eventually. Healthcare costs might rise, but other things fall. So the 4% rule might even be conservative for some. He also talks about the crossover point rule as a more personalized way to think about financial independence.
Crossover point.
That's the point where your monthly income from your investments consistently covers your monthly expenses.
Ah, passive income covers your bills.
Exactly. Regardless of your age, when you hit that point, you are technically financially independent. You could stop working. It lets you define retirement on your own terms, maybe much earlier than traditional ages.
This sounds like real freedom.
Yeah.
Okay, last big point, and it's a psychological one. He says you will never feel rich.
Oof. Yeah. That one hits home for a lot of people, I think.
Because we're always comparing ourselves. He uses the example of Lloyd Blankfein, former CEO of Goldman Sachs.
Right. A guy worth hundreds of millions, maybe more.
Saying he didn't feel rich because he knew actual billionaires. It's all relative.
It's totally relative, and that's the trap. It highlights how our perception of wealth is so often tied to comparing ourselves to others, which can just lead to feeling constantly inadequate, no matter how well you're actually doing.
So how do you break free from that mindset? Sounds exhausting.
It is exhausting. The key, he suggests, the real transformation in perspective, is to shift your focus.
Away from others.
Yes.
Whoa.
Focus on your own financial journey. Compare yourself today to where you were in the past.
Measure your own progress.
Exactly. Celebrate how far you've come. Find satisfaction in your personal growth, not in trying to keep up with some ever-shifting target set by looking at someone else's life or bank account.
That's a much healthier way to think about it. And probably leads to more genuine freedom and success, however you define those.
Absolutely. It's about your journey.
Okay, that is a powerful thought to leave everyone with. So here's the final question for you to consider. What specific aspects of your financial journey are you willing to maybe adapt or experiment with to gain a deeper sense of freedom and success in your own life?
And let's end with a really powerful quote from Nick Maggiulli's book, summing up so much of this. Though you can always earn more money, nothing can buy you more time.
Wow, let that sink in. If these insights resonated with you, please do share this deep dive. Send it to family, friends, anyone you think could benefit from these ideas.
Help spread the knowledge.
We'll see you next time on The Deep Dive.